Hey everyone, welcome to another episode of AdMail. This is Adam Bergman, founder and CEO of IRA Financial. I'm here to help you find the answers to the most frequently asked questions from my clients about self-directed retirement accounts. If you want to learn more, you can subscribe to our YouTube channel and follow us on social media. Just search IRA Financial. Hey everyone, Adam Bergman here, tax attorney and founder of IRA Financial. Welcome to another episode of AdMail. Today's topic, RMDs, required minimum distributions. 3 questions on required minimum distributions. So before I get into the questions, let me just set the table for the podcast. I'm going to briefly describe the required minimum distribution rules since they've changed since 2020. And actually, we are in a period of relief. If you are taking RMDs as part of the 10-year regime as a beneficiary from a non-spouse who has passed since 2020, you're probably in the 10-year regime. If you are not an eligible designated beneficiary, which I'll explain what that is. And actually you have reprieve for this year, as you had last year, because the IRS can't get their stuff together on actually promulgating final regulations on how the RMD rules will work. So I'm going to tackle some questions and also obviously explain to you how they work. So real quick, this is how the RMD rules work. If you are a beneficiary of someone who passed that had an IRA before 2020, you generally have life expectancy to take the money out, right? Which is a table the IRS provides. It tells you basically you have to take a little bit out each year until the IRA is depleted or you die. This is pre-tax IRAs. Roth IRAs do not have any RMDs. Under the post-2020 rules, thanks to the Secure Act 1, even though these rules are not final, there are 2 definitions you need to understand. One is a require beginning date, which is now 73 years old when RMDs start. The second is EDB, who's an eligible designated beneficiary. Why is an EDB important? Because if you're an EDB, you can choose between life expectancy or the 10-year window. An EDB is someone who's a spouse, someone who's a beneficiary that's disabled or a minor, or someone that's not more than 10 years younger than the person that died, okay, like 5 years. If that's the case, you could choose between the 10-year or the life expectancy. Most people will choose the life expectancy because you can stretch it over a long period of time. If you're not an EDB, then you're a DB, designated beneficiary, and then you have 10 years to pull the money out. The controversy is, and why the IRS hasn't been able to kind of set final required minimum distribution rules, is you can't seem to decide, should you have 10 years to pull the money out, or do you have to take it out a little bit over a 10-year period? It's like, hey, flip a coin. It shouldn't take you 4 years to figure this out, but they can't figure it out. So they keep pushing the RMDs. So if you don't take them, eventually by year 10, you would have to. The idea is that they're going to have final rules by 2025, at least by the beginning of 25, so you'll know what to do. So anyways, that kind of sets the table of how the RMD rules work if you have pre-tax IRA or 401k. So the first question is from Louis B. Louis wants to know, hi, I just lost my brother. I'm sorry, Louis, and I'm the beneficiary of his IRA. Do I need to start taking RMDs this year? So the question is, are you an EDB? If you're an EDB, meaning you're less than 10 years younger than your brother, I don't know, then you could choose between the life expectancy and the 10-year. If you choose the 10-year, you have a reprieve. You don't have to take an RMD in 2024. If you choose the lifetime expectancy, you don't have a reprieve, and you're going to have to start taking RMDs based off your life expectancy table, which if you are a client of IRA Financial, we will provide you that information. So it comes down whether you are an EDB, an eligible designated beneficiary, or you're just a designated beneficiary. And I assume your brother, if you just say recently, he passed since 2020. If you passed prior to 2020, you would just have your life expectancy. Second question is from William J. William wants to know, my spouse recently passed away, I'm sorry, and I am the primary beneficiary of her IRA. What are my options for taking RMDs? So since it's a spouse, William, you are an EDB, assuming your spouse passed away after 2020. If she passed before 2020, then you would have your life expectancy. Well, basically, you would move the IRA into your name. So if you were over 73, then you would take RMDs over your life expectancy. And again, I'm assuming all these are pre-tax IRAs. If they're Roth IRAs, there's no requirement of distributions unless it's an inherited IRA, and generally you have 10 years to pull the money out. But since it's a spouse, William, you could pull the money into your name. You pull the IRA into your name, which is the most popular. And then based off your age, if you were under 73, you would not have to take RMDs. If you are over 73, you're an EDB, and you can then use your life expectancy to pull that out, which generally starts around 3%. If you are not an EDB, meaning it wasn't a spouse, let's say, you generally have a 10-year window. But as I mentioned, the controversy is, do you have to take out a little bit over 10 years, or can you wait to the end? If it was up to me, I just would say, listen, you have 10 years as an EDB, have fun. You don't have to take it out a little every time. The key is it has to be fully depleted by the end of year 10. I don't know why that's so hard to figure out or to come to some consensus, but either way, the IRS has not made that determination yet. So they keep kicking the can down the road until they have to, which I have been told end of 24, early 25, they will issue final regs on the RMDs, which will then clarify this 10-year window. Final question of today's podcast from Carly T. Carly wants to know, I've been taking RMDs from an IRA my mom left me, but this year I am running into an issue because the RMD amount is less than the cash available in the account because the majority of the IRA is tied up in real estate. What do I do? So I guess your situation is, let's say your RMD amount is $5,000 and maybe you only have $1,000 of cash and the rest of the account is tied into real estate. It's in kind. So what do you do? So you don't want to have to take the whole real estate. Let's say the house is worth $300K. That'd be crazy to have to take the $300K as a full RMD because maybe your minimum amount, as I mentioned, is like $5 or $6K. And you still want to have the IRA hold the real estate so it could still defer the gains. So what you can do, Carly, is if it's only the LLC, for example, it's easy because then you could just take a percentage of the LLC, amend the operating agreement. Maybe you took 5%, right? Let's say the property is worth $100K, your RMD amount's $5K, take 5% of the LLC and switch the ownership from the IRA to you. Okay. If it's the actual asset the inherited IRA owns, then you would have to quit claim that percentage to you, right? Then the question is, do you then get into prohibited transaction rules? The answer is probably not if you are then prorating the cash, meaning if the income from the property is just pro rata, 95.5 in our example. You're not taking a salary, you have a management company, and money just gets allocated. You're not going to run into any issues, especially because this has occurred by operational law because of the RMD rules. So as long as the allocation is pro rata, you're not taking a salary, you're not actively managing the property, I don't see an issue with the prohibited transaction rules. I think that's probably a more prudent approach versus taking the whole real estate as an RMD and really socking yourself with a massive tax bill, which is probably not very enjoyable and may not be possible to pay off. So that's generally what occurs is people just take a percentage of that in-kind asset. You would just quit claim a percentage of the asset. You wouldn't just say, hey, I'm taking the bedroom on the top floor and I can use it. No, you would just take a percentage of the property. Let's say it's valued at 100K and you need 5K to cover the RMD, quit claim 5% to you. So now the assets own 95.5, pay tax on that 5%. And this way you save yourself the problem of having to pay tax on the full amount of that in-kind asset, which, as I mentioned, just may not be even, economically feasible. So thank you, Carly. Thank you, William. Thank you, Lewis. 3 great questions on the RMD rules. I hope they promulgate final regs on that 10-year window. It's kind of ridiculous that they haven't already. It's not that complicated. But again, that only applies if you're not an EDB. If you are receiving an IRA after 2020 as a beneficiary from a spouse, or you're a disabled, or you're a minor, you can choose between lifetime or the 10-year. If you're less than 10 years younger than the person that died, meaning 6 years or 2 years, you're not more than 10 years, like a parent, then you would have the choice of doing the lifetime expectancy or the 10-year window. If you're not able to satisfy any of the EDB criteria, then you're just a designated beneficiary and you have to take the RMD over a 10-year period, and then subject to final rules from the IRS, how that 10 years is going to work. But as of 2024, there is a pause, there's a reprieve. You do not have to take the 10-year RMD. Same rules as 23, where you also were paused. But ultimately, once you get to year 10, the IRS is like, eventually in the next 6 years, we're going to figure this stuff out, since it started in 2020. So eventually you'll have to take the RMD, but my attitude is just make it easy for everyone. Give people flexibility. Let them take the money out over 10 years. It will save everyone time. It'll save everyone frustration and aggravation, and just make things flexible and easy. So thank you guys for hanging out with me today. I hope you enjoyed the podcast. I thought it was a really fun topic. Thanks for all the questions. If you enjoyed it, great. Appreciate it. Please, if you don't mind, just a quick, short review, positive, hopefully. Thumbs up would be great. If you're watching this on our YouTube channel, definitely check it out. If you haven't subscribed, please do so, because it's great content. I post 3 podcasts and 3 videos on a YouTube live as well. So there's like almost every day, there's some great content there, and you can search our whole library of thousands of videos and podcasts that you can just learn a whole lot about various self-directed retirement topics on IRAs, Roths, solos, alternative assets, all kinds of cool stuff that I promise will ultimately make you a tax-free millionaire when you're older. It's a guarantee, literally guarantee, just based off compounded returns math. You just got to be educated and kind of trust the process, be patient, but it works. So enjoy the work. Hopefully you enjoy the podcast, enjoy all the content, and I'll see everyone again, hopefully next week. Now, thanks. Ciao, and have a good day. Bye.